Dear ladies and gentlemen, welcome to the OTP Bank second quarter and first half 2022 conference call. This conference will be recorded. As a reminder, during the presentation, all participants will be in a listen-only mode. After the presentation, there will be an opportunity to ask questions. May I now hand you over to László Bencsik, Chief Financial and Strategic Officer. László, please go ahead.
Thank you. Good afternoon or good morning, depending where you are, and thank you very much for joining us today on this very nice summer day, at least here in Budapest. I really appreciate that you've taken the time to listen to us at this time of the year. The presentation, as usual, is available on the website and has been available for more than an hour, so hopefully you've been able to download it, but we also share it during the presentation and the conf call. I try to better restrain myself than usual and give a relatively succinct presentation of the recent results, and then obviously we can do a Q&A session, which will be probably more interesting. But nevertheless, start with page 2. Maybe we can go to that page, or okay, wonderful. So I think, the glass is either half full or half empty, depending from which angle you want to look at this. If you look at the total profit after tax and the year-on-year development, then we are 80% minus compared to last year. And but if we look at the adjusted profit after tax, but including the risk cost increase in Russia and Ukraine due to the war, then we are actually in 2% plus. So considering and including the negative business impact of the war in Russia, in Ukraine, on the risk cost and on other factors in the P&L, actually, group level, we managed to year-on-year increase the adjusted profit by 2%. So that's the kind of good side of the story. The not so good side of the story is that during the first half of this year, there have been quite excessive one-offs, and part of them were related to increased policy burdens in the format of excessive taxes, one-off taxes, and this introduction of or continuation of the price cap on variable mortgages in Hungary, which resulted in terms of after tax, almost 100 billion one-offs negative. And then another kind of close to 100 billion came to other ramifications of the war in Ukraine, outside Ukraine and Russia, namely the impairment we had to book on the Russian government bonds we are holding in Hungary and in Bulgaria, plus the goodwill write-off we had to do related to our Russian asset. So huge negative one-offs the first half, but the underlying without one-off performance, I think quite respectable, despite the fact that we have this very special situation, very dramatic situation in Ukraine and the related situation in Russia. Now, looking closer to the quarterly development of profits, maybe we can go back to the previous one still. Yeah, as you can see, the profit after tax, including all the one-offs, including this large special tax on OTP in Hungary, we made actually 76 billion after-tax profit in the second quarter, which is a great improvement compared to the loss in the first. And again, the adjusted number 162. I think that's quite decent, and that's obviously far bigger than we have ever done in any quarter. And a year on year, this is like 25% up compared to last year. So maybe we can move now to the next slide, and page 3. I mean, these are the group results, including Russia, Ukraine. First of all, I have to point out that exchange rate movements have been huge, especially second quarter this year. So if you compare first quarter to second quarter numbers in half nominal terms, as we present them in our reports, you may not get the full picture. Because the half weekend, I mean, to almost every currency, except the hryvnia, which weakened a lot, and the ruble appreciated huge compared to first quarter. So, in fact, if you want to understand the dynamics here, we would rather have to look at the quarter-on-quarter FX adjusted and year-on-year FX adjusted ratios, which are kind of presented on the right side of the chart. So basically this rather strong improvement in quarter-on-quarter results from adjusted profit terms 89 to 162 was basically due to 3 reasons. One is the much lower risk cost. We provisioned much less, you will see, in Russia, Ukraine. So it went down from 73 to 32 billion. Half risk cost, the FX impact, which is quite substantial. And I mean, FX adjusted, or 3% increase quarter on operating profits. So that's roughly the picture. And again, I think it's important always to take into consideration the large exchange rate movements, which do have an impact on our numbers. Going to the next slide, which present the group results without Russia and Ukraine. And I think this is kind of important to show these numbers, especially because we articulated our expectations after the first quarter based on these sets of numbers, so without Russia and Ukraine. And it obviously does make sense, I think, to continue to talk about these two parts of the group separately. So if we just look at group performance without Russia, Ukraine, it was actually flat quarter on quarter. And the risk cost impact here was actually reversed. So we had less write back than in the first quarter. And we had some improvement in operating profits, 3% quarter on quarter. If we look at the yearly, development, then total income line 80% up year on year, FX adjusted. And that's roughly the speed with which we are growing our loan book. So, and this is not surprising because the net interest margin and in general revenue margins is close to being flat compared to last year. So basically income growth is driven by organic volume growth and business growth. And that was roughly in this kind of 17, 18% compared to last year. Important line is the cost line, and year on year we had 11% cost growth, operating expenses, which actually created a positive operating jaw, and operating profits grew 26% organically. Now, obviously, this operating expense line is the line where we will be strongly under pressure, and we will have a headwind in the coming periods, given the very high level of inflation and especially Hungary, the impact of the weak exchange rate on some of the cost elements. So this is going to be a challenging part. Now, the adjusted ROE without Russia Ukraine actually better than originally expected at 23%. We kept the guidance kind of being around the last year level, but certainly the first half performance was better than last year. Cost to income ratio improved again due to this positive operating jaw, and the risk cost rate was positive first half this year, might be actually closer to where we were last year for the entire course of the year, but we will see. Now, specifically Russia, Ukraine, a few highlights. In Russia, operationally, the situation is stable and we are gradually ramping up retail lending. So the usual POS, mass market, POS loans, and cross-sold credit cards and cash loans. And despite a large volume decline, what we saw, actually the new volume started to build up, and it does seem to be a quite profitably sustainable business even in the current environment in Russia, whereas our corporate volumes drastically dropped. So you will see that corporate loans, which were actually a small portfolio anyway, now we are 50% down. So in fact, we adjusted further the operating model, and now we really only focus on this kind of mass market consumer retail lending, and pretty much given up corporate lending, where it's extremely selective, but technically it's kind of zero. And that actually resulted in a profit in the second quarter. Obviously, we did not have to create further kind of excessive provisions because the portfolio quality remained quite stable. So we haven't seen any unusual deterioration in portfolio quality. And we also reversed most of the kind of tax asset, accrued tax asset write-off. What we did in this, we were kind of maybe too conservative after the first quarter regarding these tax assets. So we have kind of booked them back, and therefore you can see this big kind of change in the corporate tax in Russia. But if you look at the first half, corporate tax, that's more kind of in line with kind of usual performance. Now, Ukraine, again in Ukraine, we booked quite substantial risk costs, and even with these risk costs, we had positive kind of +0 performance, and which has been kind of bolstered by the rate hikes. So the deposit rate, national bank deposit rate is 25% now, and that means that even if our loans are going back down and repaid, and we have relatively subdued and limited new lending, we can actually maintain a decent net interest income level just by collecting deposits and placing them in the central bank. So that pretty much operationally or kind of P&L wise stabilizes the bank and seem to be able to provide a decent operating profit, which can certainly absorb a relatively high level of risk cost without making the bank loss making. So that's the trajectory where we are at the moment, and in a kind of reasonably optimistic scenario, this can continue. But it's very, very difficult to have any clear vision on where the situation can develop in Ukraine. It is immediately linked directly linked to the war situation in the country, and whether that abates or exacerbates makes a difference in terms of having zero or slightly positive quarterly results, or having another negative or more than one negative quarter in Ukraine. Whereas in Russia, it's as far as we understand the situation, the expectation is that from now on we are going to make okay levels of profits with a smaller balance sheet, which focuses on this kind of consumer lending, retail business activity. If we kind of broaden our view to the picture to the other group members, then I think actually the story is quite positive. So most of the foreign subsidiaries have been doing very well. Bulgaria is doing really nicely. I mean, profits quarterly up 27%, yearly 5%. Croatia has been doing phenomenal. So it's really, I think the bank, the market, the macro environment, they are joining the Eurozone. The country has been upgraded by rating agencies. The tourist season is very strong. So from every angle, they are doing quite well, and we are very optimistic. Serbia, in this difficult environment, I think the macro and policy-wise, they have been navigating quite well, and this reflects in our results. So year on year, 41% increase in profits. So this seems solid and strong. Slovenia, 22% annual increase in profits. I mean, this is the country where we are very keen to and very motivated to finally close the acquisition. Hopefully this is going to happen before the end of September, and then we can get into possession of NKBM and then start the merger and create hopefully a substantial uplift to our Slovenian nominal profits, and also to the returns that we. Romania, we again moderate profit, but in line with this kind of aggressive organic growth strategy what we have there. Montenegro, we had that operational problem during the winter period, and then at the same time we have now a new management, a CEO, and the management team is partially revamped. So I'm actually quite positive that the bank has taken an even better direction than before. Albania, very strong performance. I mean, they almost double their profit year on year, and the country is really in a very interesting situation. They are almost self-sufficient in terms of energy, and it's hydro-based, so it's not carbon related, and somehow the whole economic environment started to make sense there, and there's a rapid development. So we are quite happy with Albania, and we are even happier that we just closed an acquisition there, which is obviously not a big bank, neither compared to OTP Group, nor even compared to the Albanian market, but nevertheless makes a very good addition to our activities there, and helps to increase the market share of the bank by 50%. So this is kind of meaningful for our presence in Albania, despite the fact that on the group level it's not a big difference. Moldova is in a very difficult geopolitical situation. There's a strong recession there in the country. The IMF is there. Very high rate environment, very high inflation. enormous current account deficit. So this is a country which is in difficult situation. And I think the good news is that despite this being a relatively recent acquisition and in this difficult country, it's still making profits. I mean, obviously profits are lower by almost 40% than last year, but it's still positive, contributing to the group. Hungarian leasing, mercantile doing quite well, fund management doing okay. And then we have Russia, Ukraine, but we talked about that story before. I mentioned the acquisitions. So we nicely ticked this Alpha Bank process in Albania. It's done, and the last one in the pipeline, hopefully will, as I just mentioned, hopefully will happen by the end of September. We seem to be in a final phase before we receive the answer from ECB primarily, and also from the local competition authorities. If we dive into somewhat, but I'm not going to dive deeply into these lines, but net interest income development, and I think here it's important again to look at the FX adjusted numbers. So wherever we have this percentage changes year on year or quarter on quarter, we typically have two numbers except Hungary. The second number is the FX adjusted one, and even directionally they can be very different. For instance, in Russia, quarter on quarter, in Hungarian foreign terms, we had NII went up by 22%, but in ruble terms, it actually went down by 17%. So these numbers, I mean, the FX adjusted numbers seem to be much more reliable than the unadjusted. But fundamentally, I think it's true that in most cases, again, except Russia, Ukraine, which are special ones, it's the underlying volume dynamics which drive NII. And in some cases, we have seen changes in the net interest margin, some improvement in Hungary, but most important, but kind of decline in Slovenia, for instance, and some decline in Serbia. So it's a kind of mixed picture, and group level more or less flat. Talking about NIM, page 9 is the quarterly change, and there was some improvement in Hungary. Finally, there's a small filtering in of the rate environment, despite the kind of structure of the balance sheet, which is, I mean, we have this massive fixed assets in our portfolio, which prevent the short-term impact of the rate hikes to manifest in higher NII, but this will come in a couple of years if we're going to have this kind of low or high rate environment. A lot is related in the NIM change to Russia. Actually, if you just look at Russian standalone net interest margin in rubles, then it declined 4 basis points. But then the overall NII in Russia shrunk, and that actually had an impact on kind of the composition of the group margin, so to say. So the contribution to group level margin declined because the share of the Russian business declined, and that was actually negative because overall Russian margin is higher than the group average. So that's the others -7, mostly coming from this one. And then in the FX effect, again, most of it is coming from Russia, and the appreciation, a huge appreciation of the ruble compared to the first quarter. And again, having this kind of higher increasing share due to the FX impact. So basically, the OTP Russia standalone, the FX effect, and others, they are all related to Russia. They are only kind of taken into three parts. And other than that, Ukraine's life improved and Hungary's life improved. Okay, so looking at volumes, quarterly loan growth volumes, we had a very strong quarter at 3% or 5% without Russia, Ukraine, because Russia, Ukraine was strongly negative, 10 and Ukraine 10, Russia 11 minus. But the rest of the group did really well. I mean, 5%. And this is not annualized, obviously, this is just one quarter. Hungary was a strong rebound. You might remember first quarter it was 0, mostly because of the consumer loans being even negative due to this kind of one-off windfall payment to our retail clients by the government. And but then second quarter was 6, which is one of the strongest in the group. But all the other countries did quite well. I think 4, 5, 6% growth quarterly basis in the bigger markets, especially corporate was a strong driver. And in many cases, this is driven by working capital loans increase or quite an increase in the utilization of the working capital loan credit line. So what we see that a lot of corporates are increasing their stocks, right? So they're buying stuff, they increase their working capital and kind of what we have as raw materials and so on. This is obviously in anticipation of raw material or parts price increase, but also even the kind of the ready products volumes increase because they kind of produced for kind of reserves in order in anticipation of future price increases. So we do experience that, and obviously this is not going to last forever, right? So this is probably a temporarily 1 or 2 quarters situation, but that gave a big boost in many of the countries to our corporate loan growth volumes. Looking at the first 6 months, year-to-date performance without Russia, Ukraine, 8%. And this is obviously stronger than what we originally expected. So therefore, if you read our guidance, this is the line where we made changes. So previously we said that we expected around 10% performing loan growth without Russia, Ukraine. Now we are more inclined to say that it is going to be probably more than 10%. And it can be actually material more than 10% if unless there's a kind of unexpected development there. And again, I mean the same pattern more or less. So around 10%, 8-10% growth in most of the countries for the first half. And in some countries we have quite an interesting environment, and for you, those of you who are from the Eurozone, it might kind of get used to it, but for us this is strange to see that we have very high inflation, right? Bulgaria, Croatia, Slovenia, Montenegro, around 15% inflation and still a very low rate environment. So it means that cost of loans remain low, especially compared to the level of inflation and the level of wage inflation. So that means that even in this, it can happen that in this kind of high inflationary environment, in these Eurozone or quasi-Eurozone countries, maybe loan volume, loan demand might stay actually quite strong. Whereas in countries where the rate environment has increased a lot, namely Hungary, that's the kind of highest increase in our, except obviously Ukraine, which is a 25% rate, but that's a different story, and also Moldova, which is close to 20%. So these are, except those specific situations, obviously the Hungarian rate increase has been quite material. So, and this is going to naturally impact loan demand, and therefore the expectation is that there will be less kind of loan growth in Hungary unless more subsidized rate products come and structures come. There have been some positive development on that front. So we probably heard that the baby loan program has been extended by another year till the end of next year, and there's this Széchenyi card program, which is primarily an SME loan facility, refinance, and at the subsidized rate, quite attractive. That continues, and that has been somewhat extended. So this is the right time for these subsidized structures to come in place, and we will see how much is going to come and how much, to which extent they are going to moderate the otherwise inevitable decline in demand for new loans. Deposit development, quarterly 1%, and for the first 6 months, next slide, 5%. So the kind of deposit growth slowed down somewhat. It hasn't been in our focus, obviously, and given our liquidity, it's not in our focus. But what very important is the Ukrainian and Russian situations. I think it's important to note that both of these countries' deposits have been growing, despite the fact that we are very liquid and liquidity situation improved a lot in these two countries, given the huge decline in loan volumes year to date. So we are not hunting for these deposits; they are coming to us, and I think that's a very strong, very positive feedback that even in these very distressed situations, clients trust us, maybe even relatively more than some other banks in countries where we are not big. So in Russia, we are tiny, and in Ukraine as well, we are one of the smaller banks. So this is not that we are kind of major players in these countries, but there must be some other reason. Fee income, year on year, 15% growth. Again, this is more or less in line with the overall kind of growth of the kind of group activities and lending. In some countries it was stronger, Hungary, Bulgaria, obviously Ukraine, Russia, year on year, it's negative, which is not surprising given the situation. And there's some quarterly noise as well. Typically in Hungary, first quarter is there are one negative one-offs, therefore usually the kind of growth in the second quarter is bigger than usual, but there's nothing fundamentally new here to mention. Page 15, other income. Again, there's some noise here, especially in Hungary, between the first and second quarters, so, especially related to swaps, ruble swaps, positive first quarter, negative in second quarter. That difference explains kind of half of this quarterly change. But I think if you look at the and also the year-on-year development is mostly explained by technical one-offs in the base. Again, there's not so much news story here other than typically technical changes in the base or in the recent periods. Operating costs, so far okay, but obviously this is something to be watched because in this, again, high inflationary environment, we are exposed to these cost pressures, right? I mean, wage inflation high, energy prices. Banking is not a kind of energy intensive business, but we do have utility costs. They're going up, and especially the Hungarian forint weakening is causing increase in kind of real estate rental fees and in IT costs. But so far so good. So again, positive operating jaws, but this is going to be a strong focus, obviously, in the future to try to moderate cost growth, despite the fact that inflation is very high all around us in every country. In terms of capital, liquidity, there's not much development other than we probably heard that we kind of issued a green senior preferred bond. This was our reintroduction to the market. I think last time we issued a senior bond was somewhere in 2006, so kind of 16 years ago. It may not have been the best time to start issuing bonds again, but we are obviously under pressure from the regulator to fulfill the increasing MREL requirements. Therefore, we had to start this, and it was quite expensive, 5.5%. Or, well, expensive is relative because, in fact, we were one of the very few financial institutions from the region who managed to issue anything in this quarter or in this period, last couple of months. Actually, it happened in July, so after June. And we have seen higher coupons with similar rated banks from the region. So in that perspective, even the pricing was kind of okay, but this is certainly a very different environment in terms of cost of wholesale funding. But despite the liquidity situation, it's not so much a choice to do this. This is a regulatory requirement, and we will continue the last 1.5 years, especially to come to issue new primary senior bonds to eventually fulfill the requirements. There was a lot of movement in the capital and in the risk-weighted assets due to, maybe if we go back to the previous page, just comment is the again exchange rate, FX rate change related changes in our capital base and in our risk-weighted assets was quite big, right? So you see the first lines in, 313 billion increase in the capital and 1.4 trillion half increase in the risk-weighted assets due to the FX rates changes. And this is just that we kind of, there's this natural hedge more or less in the group balance sheet or in the group capital adequacy. As risk-weighted assets grow due to weaker half, the relevant regulatory capital increases as well, so that FX rate changes explain quite a bit of the changes in the capital base and in the risk-weighted assets. In terms of coverage and portfolio quality, again, not so much change. Obviously, due to the increase especially in Russia, there was some increase in stage 3 ratios due to the declining overall portfolio. Likewise in Ukraine, some increase, but it's not underlying so much. So it's just because the total loan volumes decline, and therefore the ratios somewhat increased. So that caused the increase quarter and quarter, but it was like 10 basis points, so it's not big. And I think in terms of level of coverage, we remain to be typically higher than some of our regional competitors. Usual 3 slides. Well, Hungary specific performance. I think one factor here is important, and if you look into the analyst tables, which are in Excel format on the website, you actually can spot it that already for instance, mortgage demand for the market-based structures dropped substantially in the second quarter. So that we do see, and despite strong new mortgage generation and strong new applications, most of the strongness is basically explained by the subsidized green housing loans and demand for that, and for the kind of market-based structures, the demand, I mean, this is not surprising, already dropped significantly. That means that if there's no further subsidized structure coming from the state, then it's likely that Hungarian mortgage lending in general will slow down. I think that's an important message to make. Corporate loans was quite strong, again related primarily to this working capital loan volume increase, which is related to the usage of the credit lines our clients have had. ESG remains a strong focus overall, and again, the bond what we issued in July was a green bond, so it was not just our first senior bond for 16 years, but it was the first ever green bond, and actually there was a quite positive investor reception to the structure, and I think we have done a lot in this dimension during the last couple of years, and we will continue to focus our efforts on E, S, and G factors parallel. Finally, a few words about expectation. I mean, certainly the second quarter was rather more positive than we originally expected, so to say, and that suggests some, actually, well, at least short-term limited optimism, I think, and we only decided to reflect it in the loan volume expectations. So again, without Russia, Ukraine, group level loan growth we expect to be over 10%, as opposed to previously expected to be around 10%. So now this obviously suggests and reflects the 8% year-to-date performance. So it's not hard to imagine that it's actually going to be more than 10. I think it's still likely that net interest margin will remain stable. It's slightly increased year on year, might be some slight more increase, but not material. Cost efficiency improved. We're happy about that. Risk cost ratio, again, first half, it was actually positive, or now, I mean, it's always a problem with these kind of, whether the risk cost ratio is positive or negative. So we had write-backs with that Russia-Ukraine portfolio first half. So therefore, the ratio is better than last year. We will see. I mean, these are quite small numbers, either positive or negative compared to the size of the group. So at that level, it's kind of hard to be very specific about the forecast. I think the best kind of guess is that it's going to be the whole year going to be at the level of last year, the risk cost ratio still. And profitability, again, this kind of adjusted without Russia-Ukraine number. First half was much better, was actually markedly better than last year, but we kind of remain cautious in our guidance, and around last year can mean that it can be kind of higher than last year. So Russia, I already told you that we expect kind of moderate profits, but profits to come from our Russian business. In Ukraine is, I mean, it's just close to impossible to forecast what exactly is going to be the quarterly performance there. It is 100% dependent on how the war situation develops. So that was the kind of presentation on my side, and I'm sure you have very, very good questions to ask, and we'll try to answer them in a meaningful way. So please open the floor for questions.
Thank you, ladies and gentlemen. We will now begin our question and answer session. If you have a question for our speaker, please click on the raise hand icon to indicate or press *9 on your phone's dial pad. One moment, please, for the first question. The first question is from Hai Tan Lepong, Concord Securities.
Hi, can you hear me?
Yes, loud and clear.
Okay, thanks. Thanks for your presentation. Just 2 questions from my side. The first one would be on your rate sensitivity to euro rates. So I think in the previous call you said it would be around 3 billion for every 10 bips. So shall we translate the first 50 bips of euro rate hikes to impact your interest income accordingly, and how you see further rate hikes would impact this line? And my second question would be on the agricultural moratorium that was introduced recently in Hungary for agricultural companies. And I was wondering if you could tell us what is the exposure in Hungary for that sector in your loan book. Thank you.
Yes, indeed. So the answer for the first question is yes. So the 50 basis points rate hike we have seen so far should translate into 5 times 3. And it's the kind of forward-looking sensitivity is even higher. So it's roughly 10 million euro per 10 basis point. Is 4 billion forints in current terms. And the difference is because now we are in a positive territory. So I mean, we in some cases we could not have we didn't have negative reference rates. Therefore, up until it went up to 0, in some cases there were no increase in loan rates. I mean, these are typically corporate contracts, and they differ in countries and by clients, so it's not kind of overall, but we have quite a lot of contracts which work in a way that the kind of reference rate could not go below 0 in the pricing according to the contract. And so far the rates of these loans have not changed, but from now on they will, so that somewhat increases the sensitivity here. The loan book which can be impacted total is 250 billion. And to be honest, plus there's another 50 billion off balance sheet credit line. So if you take the on and off balance sheet amount, that's like 300 billion, which is it's not a huge portfolio. It's pretty much impossible to tell how many clients so it's not it's an opt-in structure, so it's not automatic that clients participate. And the clients will have to decide first half of September. Obviously, we will try to communicate to these clients, and we are very hopeful that these clients will actually approach us and discuss problems if they have any. There has been a strong drought in Hungary. It's really strong, and some, especially crop production, is strongly affected. So yes, some producers experience troubles, but it is certainly not across the sector. So hard to. We don't have a good number how much participation we should see here.
Okay, thank you.
Sure.
Thank you. The next question is from Máté Nemes, UBS. I open the line.
Hi, good afternoon, and thank you for the presentation. I have 3 questions, please. The first one is on market shares in Hungary. Can't help to notice, but essentially in all products and segments, you're showing growing market share, be it in mortgage loans, cash loans, or on the corporate side. I'm just wondering if you could give us a sense why that might be. Is that basically the willingness to continue supplying credit, whereas some other banks are holding back? Is that due to pricing, or if there is any other factor? That's the first question. The second one would be on intragroup funding to Russia and Ukraine as well. I just noticed that in half terms, we've seen an increase. Can you just confirm that this is simply due to the Hungarian forint depreciating versus the ruble and the hryvnia, and that there's no actual increase in local currency funding terms? And the third question is on Ukraine. You mentioned that currently you're seeing strong deposit inflows, and you're placing this at the central bank at very high short-term rates, money market rates. Can you give us a sense what portion of your NII is coming from these deposits placed at the central bank in Ukraine? And perhaps also how much is cash and how much is accrual on the NII side currently? Thank you.
Yeah. I'm just writing down the questions not to forget them. Sorry. Okay, so Hungarian market share increase in retail. It's basically a composition result. Maybe we can go to these slides, page 19. Let me go to page 9. Thank you. So we always have higher market share from subsidized products. You might remember. So baby loan, and we had like more than 40% market share. Actually, it's on the following page. So a baby loan market share, as you can see, it has been always about 40%. If you go now, also the green housing loan, which is a subsidized product, we have a much bigger market share in this subsidized product than in general. And what happened, if you go back to the previous page, what happened in the second quarter, that both in consumer loans and in mortgages in retail, the market rate based normal products volumes declined, new volumes, right? And a much larger share of new production was coming from subsidized products. And in the subsidized products, we have always had much higher market share than in other products. So it's not that we have done something differently, it's just the demand structure changed, and we happen to be stronger on the market in the subsidized products, and the demand increased in subsidized products and decreased substantially in the non-subsidized products. So that's the explanation, and these are very kind of low risk. I mean this green housing loan, I mean it's 2.5%, right, max, for 10 years fixed or whatever years fixed, even more, right? So this is it's a gift, more or less, to clients who can take in this environment. I mean, if they put the money, I mean, they can't because they have to buy obviously a real estate from this money. But if they anyway had the money and take this loan and put into a government bond, they earn kind of whatever, I mean, 7% or 6%. Right? So these are actually quite kind of low risk products. So that's the reason. In retail and in corporate, actually the increase was is kind of smaller in terms of market share, and it's more like this trend, right? We have seen this trend for many years in corporate, that we have an increasing market share in corporate loans, and that kind of the market share increase actually slowed down sort of in this year compared to last year and previous years. So again, there's nothing kind of specific or extraordinary there. And we do have this same phenomenon in corporate as well, especially SME. On this slide, on the right lower corner, you can see that, for instance, this OTP Group program, which is a subsidized scheme, a refinance scheme, quite attractive. We have 37% market share, right? And our overall market share in corporate loans is 19.2. So, and obviously in this higher rate environment, the new demand is much stronger in the subsidized, for the subsidized products than for the non-subsidized products. So a kind of similar change here. So it's not that we are more relaxed than others and less conservative. I don't know how conservative others are, but I think we are conservative. Now, intergroup funding Russia, Ukraine, I can confirm that the increase is only due to the fact that we have a weaker half rate compared to ruble. In fact, I mean, Russian entities could pay back a substantial part of this funding. The problem is that they are not allowed to pay back, or they can only if they were to early repay these loans, they could, the amounts could go only to this C account, which is kind of trapped in Russia, so it doesn't make any sense. And the same in Ukraine. It's not possible to pay back the cross-border, the maturing group credits. But nevertheless, I mean, in case of Ukraine, actually their placement in the group increases. So the net funding is actually going down. Not that it matters a lot, but that's what happens. So yes, it's not due. We have not increased our funding to any of these entities from the group. Cash accrued ratio. I think the second quarter, the accrued part in the NII was 18%. And the share of and we have like 12-15% of our assets in central bank deposits at the end of the second quarter, and this is going to increase.
That's very helpful. Thank you for all the details here. Thank you.
Thank you.
Thank you. The next question is from Gábor Kemény, Autonomous Research. I open the line.
Hello. A couple of questions on Hungarian asset quality. First, please. I mean, the economy is slowing and the utility price freezes are being phased out. How do you think about the provision outlook in Hungary in this environment? And how do you capture this in your guidance of stable risk costs, admittedly from a fairly benign H1 starting point? And the other question is, how do you think about a more negative macro scenario, and in particular a Russian gas cutoff potentially? How would that impact your provision outlook? And my last question would be on Russia. You had a comment earlier today that you might consider a sale. What options do you see to potentially work around the government decree banning the sale of foreign assets? Thank you.
Yeah. So, I mean, certainly the developments, the high inflation, and especially the excessive energy cost is negative, no question about that. And it's going to have a negative impact on our risk costs and portfolio quality. How negative? I mean, that's actually very, very difficult to tell. And I mean, again, we made this guidance that we expect a similar risk cost rate this year to last year. Last year we had some kind of risk cost for the whole group, and this year so far, except Russia, Ukraine, we had write back. So, I mean, the fact that we expect kind of similar levels to last year still means that there will be more risk cost second half than first half. I'm talking about without Russia, Ukraine, because Russia, Ukraine hopefully will be less. Now, in case of Hungary, I mean, risk costs are kind of very positive, right? So, I mean, this first 6 months we had positive 19 billion. Last year, first 6 months we had positive almost 8 billion. I think this is not going to continue long, so probably we will start to see periods with normal kind of risk costs, which means kind of negative risk costs. I think in a way this positive risk cost is abnormal, and that's due to the fact that kind of 2 years ago we made these large provisions for COVID-related problems, and COVID-related problems did not happen at all. So we have still kind of reserves, and kind of slowly we started to release these reserves. But now we have another problem, which might be more material than the COVID impact was, because COVID was rather kind of, we were scared and provisioned, and everyone was kind of negative 2 years ago, but at the end, basically, the situation turned to very positive, but at least, I mean, in terms of portfolio qualities and banking kind of sector results. What happens now? I think it's extremely negative and difficult to tell. I mean, in a scenario where there's no gas, no Russian gas at all coming to Europe, I mean, that's a rather dire scenario. And and not just to Hungary, so across Europe, especially Germany, some other CE countries, which are heavily dependent on Russian gas. I think it's very, very difficult to kind of capture the magnitude of the problems we are going to have. I think if that happens, then we will have strong policy measures, not just in Hungary, but across Europe, because this is not something which can be left to the market to be solved, I think, a situation if that happens. And I don't know how to quantify that, honestly, but it's certainly negative. I think a kind of a complete stop of Russian gas, and that's certainly a tough scenario. And I don't know how Europe will going to cope with that if that happens. But we also have to remember that this is a political decision. So this is related to the war and related to the sanctions which have been imposed due to the war. And if there's no gas, then this is the counter sanction to the sanctions which were kind of triggered by the military actions and the war. So this is not something fundamentally economically driven, or it's not a fundamental supply-demand imbalance. It's just it is a political decisions, and I think I can only hope that political decisions will be wise on both sides, right? Because if not, then if kind of irrationality and tit for tat negative spiral continues, then we might have actually strong problems, and these problems will not be specific to Hungary or the region, but certainly more, at least more on a European level. Sorry, what was the last question? It was related to, yeah, Russia, right? Okay, yeah, selling. So I don't know. I mean, there was this presidential decree that foreign banks, foreign assets cannot be sold. Now, every presidential decree can be overwritten by a presidential decision. So I'm sure it technically it's possible for a Russian president to give a kind of one-off approval. So we haven't digested this so much. Again, we started the process to explore if there's interest for the asset, and I can confirm that there is local interest for the asset. Obviously, it is unclear to which extent meaningful discussions can continue in this situation, whether potential interested parties, Russian parties, want to engage in a more meaningful and more detailed conversation and process given this ban. Because it's not just that we cannot sell, but they are not allowed to buy it, right? So I don't know. So this is it probably it does definitely at least slows down the process, and it has slowed down the process. We remain open to this, and we continue to explore strategic opportunities. Having said that, if we kind of just look at the economic fundamentals of the situation, as I said, we stabilize the operation. Actually, it's self-funded, it's profitable. It focuses on a segment which is, I think, the least sensitive politically. It's just the kind of mass market retail, or even below mass market retail clients we have. We stopped corporate lending. We are tiny, by the way, in Russia. So we are number, I don't know, 50 or 40, whatever bank. So but it's still sensitive politically, and we understand that. Having said that, we have regional competitors who are top 10, right? And still there and making enormous profits in Russia. So put it this way, we are going to monitor what they do with their assets and how they tackle the situation, and then I think that will be a guidance for us as well, given that we are tiny compared to them, and we are not serving state-owned or corporate clients in Russia. We are only serving kind of low mass market retail clients when they buy a whatever microwave oven or a TV or something like that. So I think it's a kind of different profile and much smaller. But we do keep our eyes open and continue to try to explore the different strategic alternatives.
Thank you, Laszlo. Useful color. Just one small follow-up. Can you remind us how much overlay provisions do you have as of now, and how much you mentioned, I think, some releases in Q2. If you could quantify that as well.
I mean, in Hungary in Q2, risk cost was plus 18 billion, right? So I mean, that's overlay. I don't know what an overlay means. In fact, I mean, sometimes it happens that you have situations when you create provisions based on kind of expert judgment, maybe more than on models. But in our case, everything is model based, right? And the models so we don't quite. I mean, we don't have an overlay which we just put there, right? Based on no data, right? So for Russia, Ukraine, we do have models, and the provisioning is model based, and our models for the rest of the group suggested that we needed less provisions than what we originally thought we would need under a stress COVID scenario, right? So the COVID situation officially stopped to negatively influence our business activities in the first quarter. So we have adjusted our models according to that, and that resulted in lower provisions in some countries. So I don't know. I mean, I think this overlay from a kind of accounting point of view, you cannot really. It's not very meaningful because you can only provision or release provisions based on some underlying rationale, and that rationale has to be either related to some observed client activity or changing client activity or the ability to pay, or a specific economic model you have for the expected risk cost for the future.
Yes, I meant.
We don't have an overlay which is somewhere outside this framework hanging over all. I mean, so we don't have that. And I don't know how others can have that, if that's what you mean.
No, that's fair. What I meant was the provisions you created during the COVID crisis, given your macro assumptions back then, which you have not yet released, even though the macro situation let's say, turned out to be more favorable than you had assumed. But it sounds like there's not much of that.
We have released them and we reallocated them. Partially we released them, and that's what you see. Partially we reallocated them, or there all of a sudden there's another reason to provision more and to be kind of less optimistic or pessimistic for the future. And that's the current economic environment, which is obviously deteriorating. So it was that, I mean, yeah, the COVID reason ceased to exist, but that now there's another kind of negative scenario we had to take into consideration. We calculated the two, there was a difference, the difference we released, and we have a new one now. So that's the situation.
Okay, that's fair enough. Thank you.
Thank you. The next question is from Anne Webborn, Societe Generale. I open the line.
Hi, can you hear me?
Yes.
Good. Thank you for the call today. Do you think that in terms of the way the government in Hungary is managing, its budgetary needs and so on, is rational in terms of how it's working with the banking sector? I mean, for example, we look across to Poland, and it doesn't really look as if the reaction of the authorities at the moment is particularly rational. Whereas in your case, you've been slapped with a 2-year extra bank levy, but at the same time there are big subsidized loan programs, which from what you said today seem to be supporting volumes. But these programs surely must now be more and more expensive for the government to maintain. And I wonder, do you feel confident that when the government says it will continue these support programs for some time, that you can rely on that, or are we actually faced with a fairly important risk that these programs get withdrawn, and until rates come down, you could have quite a sharp contraction in lending as a result? I just wondered how you feel that's working, and what you feel about the development of Hungary, given the fact that you've got this take away with one hand and give back with the other. I'd be interested in your view on that, and in terms of your own reaction to the new bank levy. I mean, are you able to do anything in terms of commercial policy to take something back, or is that just something that's not really within the spirit of how the relationship is moving forward? Hungary, and then in terms of Ukraine, were you positively surprised by the lower level of risk costs in the second quarter? Was there anything specific, better collateral, better collection, that pushed that forward? I mean, I hear what you say in terms of it's not very foreseeable, but I think we were positively surprised to see Ukraine back at break even in Q2.
Oh, the first question is actually quite difficult to answer. I think it's clear that it's unusual how the policy environment works in Hungary. There seems to be a lot more intervention than kind of usual, I think, or than the usually expected level, put it this way, in general in Europe. But this is not a new phenomenon, right? I mean, it started back in 2010. And first it was negative, so we get the bank tax and the forced conversion, early repayment mortgages, so on and so on. And somewhere the tide turned around in 2015 when politically growth became the primary target. And since then we have seen a deluge of different subsidized products for retail, for corporate, in various forms from the central bank and from the government, and it's clear that we have benefited from these, and And given our strong franchise and kind of ubiquitous presence in the country, we tend to have higher share of these kind of subsidized products than the kind of normal products. So even relatively speaking, we probably gain more than some other banks from these structures. And then time to time we got these hits, right? And I don't know where the right balance is, or whether balance is actually taken by anyone. We were.
I guess my feeling is that
Yes.
a lot of the support programs before interest rates went sky high were to some extent a choice. They were good for the consumer. They were good for you, and supported growth. Now they seem to be really quite expensive for a government that doesn't have any money, and without that, the people and the businesses that would be taking loans from you would be paying an awful lot more. So it seems to me that you are now, for the moment at least, a lot more reliant for the loan growth and the margin that you're getting from these support programs. And should they not be there, Hungary would be much more difficult. I mean, is that something you recognise?
Yes, obviously. Yeah, I think that's very obvious what you just explained.
Okay, and have you been able in your commercial policy to do any offsetting, or is it not really something that you can do? I mean, if you've got these bigger market shares,
you cannot change the existing contracts, right? I mean, we cannot increase fees due to this. But in terms of new, I mean, it can be priced into new production, but pricing is market-based. So it depends on how the banking sector reacts to this. And I think here, typically the most important one, whether what the expectations are, whether other banks expect this to kind of be temporary for 2 years, which we are hopeful that it is, or not. And if not, then obviously it has to become part of the new pricing. But the existing product pricing we cannot change, right? So that's not allowed. And this was certainly not the purpose of the measure, and we cannot do that. So I mean, we are not in a position to change legal agreements with clients. It's only the only policy level decisions can overrule the existing legal contracts. Right? Now, Ukrainian risk cost second quarter was not a surprise to us at all. I mean, again, I think we quite diligently and conservatively provisioned in the first quarter for expected losses, and since the environment developed according to those expectations in the second quarter, there was no reason to create even more. Having said that, we actually provisioned a lot in Ukraine in the second quarter as well, right? It was 22 billion of equivalent risk cost in Ukraine, whereas in 2021, the whole year we had 7 billion risk costs, right? So in this one quarter, second quarter, we provisioned 3 times as much as in the whole year of 21. It was just less than a half than we did in the first quarter. So I mean, that's.
Okay. And the fact that you sort of don't make a statement saying you feel you've done as much as you need to, that's simply based on the lack of visibility as to what the situation will look like at the year end, because you would suggest that if things had got worse in the second quarter, then you would have not reduced, and so but your statement about the rest of the year unsurprisingly isn't positive, is it, on Ukraine?
we are hopeful, put it this way, right? I mean, because in this tragic situation, the only thing you can do is to be hopeful, and especially if you have people there, you are responsible to kind of try to project a positive picture of the future, and this is what we try to do. But obviously, we are all subject to the military actions there, and we are not able to predict what's going to happen.
Okay, thanks for that.
Thank you.
Thank you. The next question is from an attendee joined via phone. I open the line. You will receive an automatic message about it. Please press *6 to unmute. May I ask your name and company, please?
Hi, can you hear me? Joseph from the KLBP Securities. I have a few more questions on the outlook of net interest income. And namely, for some time, you've been cautioning that the upside sensitivity of the NII in Hungary to rising rates is on a declining trend. And my question is, have we actually reached a tipping point in the second Q? And I want to put this question in the context of the past quarter results, when you mentioned that the NII in Hungary was hit by 12 billion quarter-on-quarter negative difference generated by the swaps. Hence, I mean, for simplicity, if we assumed an upward correction of first Q22 NII generated by Hungary core, then second Q result would actually be softer, I mean lower in quarterly terms. So where do we stand today in terms of the potential upward sensitivity of NII in Hungary in this rising interest rate environment? So that's my first main question.
In terms of net interest margin, there's not much sensitivity. So short term, I mean, it's more a kind of 2-3 years horizon where our fixed assets will reprice either gradually in terms of the kind of fixed mortgage portfolio, or just because replacement and the new when we replace the maturing government bonds, there's a higher rate there. The corporate the variable corporate loans are pretty much kind of balanced. The potential impact coming from the variable corporate loans, and I'm talking about half, right, is more or less counterbalanced by the corporate deposits, which are also variable. Now, where we have a positive sensitivity is the euro, the FX loans, and we do have FX loans in Hungary as well. And then I just talked about the overall kind of group level sensitivity to the euro rates, and that's like 10 basis points, roughly 10 million euro NII a year. So that's but the short-term sensitivity of the half portfolio's net interest margin is close to, it's roughly zero. And it's very sensitive to the deposit pricing. It can even be negative.
Actually, yes, exactly. That's I believe that's the question of the deposit pricing upward pressure. So I assume for the moment it hasn't become negative yet, even given what we are seeing on the term deposit rates offered to households.
Yes.
Another issue here is that the share of term household deposits is actually at all-time low, below 20%, whereas in the past it used to hover around 80%. So do you expect this share of time deposits to increase for some reason more rapidly in the coming future?
Yes. I don't think it has ever been 80%, but certainly more than the current level is the likely scenario. I mean, there are a lot of factors here, right? But liquidity levels on the market, the market is very liquid. The extra tax, I mean, this the kind of alleged reason for this extra profit tax was this one, that the banks make so much money on because they don't increase the deposit rates, right? And they kind of have taken away that extra profit. Now, in our case, it's not there, right? But for banks, there are some banks in Hungary who have not bought any government bonds, for instance, in the previous years. So for them, they actually have quite a big increase in their NII. Right? So I think, I mean, deposit pricing is subject to competition, right? The banking sector is very liquid, and everyone has been hit by this huge extra tax. So I'm not sure. So I mean, but we are exposed to this risk. Put it this way, that there is a risk of a potential kind of increasing the competitive pricing of deposits, and that's going to be negative for our margin in Hungary, for sure.
Fair enough. And lastly, the guidance on the euro, the ECB interest rate upward movement. Here I wanted to ask, did you include in that figure the potential of the loan books to reprice in locations like Croatia or Bulgaria, or did you only count in purely euro-denominated exposures?
No, that's across. Yeah, so I mean, technically, I mean, the Croatian and Bulgarian rates are in sync, more or less. Having said that, in Bulgaria specifically, loans are retail loans are all variable, but they are the basis here is not a market. It's not a market benchmark, or the base rate is the kind of average cost of funding of the banking sector. So it's actually related to the average deposit rates in Bulgaria, which is a number published by the central bank regularly. So that's the index.
Okay, thank you very much.
It's actually similar in Croatia as well. They have a specific kind of national bank rate, which is the average deposit rates, and that's the benchmark for the retail. But for the rest, for corporate loans, which are Euribor based, that's included in this guidance, which I give.
Yes, got it. Thank you.
Thank you. The next question is from Otto Gebudze. May I ask the name and the company, please?
Good afternoon. This is Otto from Morgan Stanley. My question is about the corporate loans that you mentioned, where corporates increasing working capital in Hungary. If you could comment, which industries do you see this in the most, and what are the drivers or your expectations in the second half of the year? And secondly, you mentioned interestingly that the deposit bases in both in Ukraine and Russia are increasing, despite you being a relatively small player and despite all the challenges that are happening in this economy. So I imagine it's hard to give a concrete reasons for this, but just interested in hearing your thoughts. And lastly, about your ROE guidance, you expect it to stay similar to 2021 levels, but at the same time, your loan growth is expected to be higher than last year. Your cost of risk is relatively stable. Your NIM is relatively stable, potentially surprise on the upside. So what is the negative factor that that balances all this out, and why ROE this year is not going to be higher than last year? Thank you.
I mean, it's not just Hungary, this working capital loans kind of increase. You see that Serbia, Croatia as well. These are typically corporates who do production, right? Who have those who have inventories, and then they produce more for inventory, and then they purchase more for inventory in order to stock up the parts they need, and then also stock up the output in expectation of this. Is, I think that's that's normal reaction in high inflation environment, right? You want to buy what you need to source, you want to source it at a lower price, expecting their prices to go up, and what you sell as a product, you want to wait for prices to go up, right? So this is and in order to balance this situation and to fund this, you increase your working capital loans, right? I'm sure this is going to have, this should be a kind of normal practice across Europe, I guess, where there's high inflation. Positive increase Russia-Ukraine, I think it boils down to trust. I think we have, despite being small, in Ukraine, I think we have a very good reputation. It actually started with Raiffeisen, because this bank, what we have in Ukraine, we brought it from Raiffeisen in 2006. And Raiffeisen entered Ukraine somewhere in 97, 98. So they were there at the early 2000 crisis. They stayed there. They stood by their clients. And we brought this bank, and then came the kind of 08 crisis, and we stayed there, we stood by our clients. And then came 14, 15, the war, when the war started again, we stood by our clients. And that, I think that has just built up a very positive reputation, what we have. And I think this has been recently reinforced by the amazing heroic work of our colleagues there to maintain banking services in a war situation. And obviously it helps that we are a foreign bank, and therefore there's more kind of a certain increased level of trust in these institutions in these difficult times. Same in Russia. I think the kind of foreign-owned banks, I mean, if you look at, I'm sure you follow our competitors, like, which are much bigger in Russia than we are. They had an explosion of their profits there and their deposits and so on. So there's a strong flow of businesses towards foreign-owned banks in Russia. Right? One reason, and there are technical reasons as well, right? We have access to international payment systems. Some big banks and many banks in Russia do not have. Having said that, again, we are cutting back our corporate business in a big way, especially lending, but I mean, these are important factors here. Now, ROE guidance, yeah, we could have increased it, but I think the wording was kind of considerate when we made it. We said around last year level, so it can mean somewhat higher. Having said that, I also indicated that for kind of outside Russia, Ukraine, we expect higher risk cost, or actually negative risk cost, the second half of the year, as opposed to the positive risk cost or the provision releases what happened during the first half. So this itself will make worse somewhat the profitability of the outside Russia, Ukraine activities for the second half of the year. to which extent, this is difficult to tell, right? I mean, look, we have been, even during this call, there was a question about the scenario if there's no gas, if gas supply stops to Europe, I suppose. I mean, that's a really dire situation which can trigger much higher risk cost than so there can be scenarios, I think, and these scenarios are, I would say, some people really expect them to happen on the market. So if those scenarios manifest, then actually risk cost can be much higher, and that would have an immediate effect on our returns as well. So I think it's still the right thing to say that probably around last year, right? And we added one more. I mean, there's one more kind of comment there that was kind of word which is important too. Where is it? Yeah. Risk cost rate, right? We added another word here, and that is further, right? So the credit risk cost ratio may be around the 2021 level, provided economic expectations won't deteriorate materially further. So the further was not there in the previous one. Now it's there, because I think what we reasonably expect to happen, it's included, but there can be much worse scenarios, unfortunately, manifesting for the remaining of the year, or for the winter, or for next year. And it's only, I mean, only our imagination creates a limit how worse the scenarios can be.
It's very clear. Thank you for the detailed answer.
Thank you. If you have a question for our speaker, please click on raise hand icon to indicate or press *9 on your phone's dial pad. As there are no further questions, I hand back to the speaker.
Thank you. Thank you very much. Thank you for spending your precious time with us today on this wonderful summer day. And thank you for your very good questions. I wish you all the best. Very happy remaining summer holidays. And please join us when we report our third quarter results. We expect that to happen on the 10th of November. Until then, all the best and goodbye.
Thank you for your participation. The second quarter 2022 conference call is closed now.